Rohit Srivastava joins us this morning. Rohit Srivastava, founder and market strategist, IndiaCharts.com. Thank you so much for your time this morning and pleasure having you back with us right here on News9. Not a great start for markets, and you're seeing pretty much every stock, every sector in the red this morning. What are investors fearing right now?
Well, I think a lot of it is the overhang from the recent news flow around H-1B visas, tariffs for the previous overhang. So we've sort of not gotten over it despite the news around the GST trigger that could, aid some parts of the market. But how I would look at this is really that the markets become slightly fractured when you look at performance across sectors. We do see, some segments of the market doing well over a period. Like if we take a 1 month view or a 2 month view, then you'll find that certain segments of the market have actually outperformed while others have lagged behind. So I think that divergence is something that we need to seriously take into account and, consider investing accordingly. So there are sectors you're going to avoid, there are sectors you're going to be with. And I think the correction should be more or less getting to the end of it. It's fallen for 4 days and we are sort of back to where we were on the 15th of September. So I think the downside somewhere is going to be limited. And we will see a pickup in the momentum again as we enter the festival season.
So there should be some momentum as we head deeper into the festive season, which began with Navratri on Monday. But what are you making of the consumer durable sector, Rohit? Because one would anticipate that this is a sector which is poised for great revenue uptake in the festive season. Are we just seeing profit booking, or is there some sort of a fear that perhaps this rally is going to be short-lived when it comes to consumer demand?
No, I think the market pretty much ends up anticipating things well in advance. So if you look at the moves we've seen in parts like the auto segment, for example, the two-wheelers, that's actually ended up happening well ahead of, the festival season. So we've seen one rally. I think you're just seeing some profit booking over here. It will not change the overall outlook on a 3 or 6 month basis because you do have lower interest rates, which also further help that segment. So I think it's only a temporary setback, or rather, like you said, profit booking, because there have already been significant gains since the announcement of the GST.
Is that the sentiment even on the consumer non-durables, the FMCG pack? Because even the FMCG pack seems to be completely wary of what is the path ahead? How much is it going to really, lead to a valuation gain? So again, are we seeing profit booking? Because this was one sector we did not see rally as much as the consumer durables segment. So what do you make of the FMCG space right now?
The FMCG is typically a defensive sector. So, it picks up only when markets are very, very poor. If you actually look at June and July, when the market was falling, the FMCG stocks were going up. Now you're seeing the contra of that. As markets have picked up a bit, you're seeing profit booking in the FMCG segment. Overall, if we look at FMCG, they were the top performers of the last decade. We are most likely not going to be the top performers of the coming decade. And therefore, while you might see an uptick, I don't expect aggressive buying in that part of the market. So it's really going to be focused more on the discretionary spending rather than, the FMCG part where, valuations being high, growth being sort of on the margin. You can't really expect exponential returns there, but I guess they will move along with the market. But right now, I think it's because they went up when the market was going down that you're seeing the reverse trend.
Now shift focus to the tech services sector, which is, of course, the most impacted when it comes to the H-1B visa issue, which, Rohit, you also spoke about just now. Now, if you go beyond, let's say, just the Nifty 50 tech space and look at the entire Nifty 500 space and the entire tech sector there, the trend seems to be that the mid-cap stocks like Persistent as well as Coforge seem to be losing a lot more ground than the blue chip stocks of Infosys, Wipro, TechM, etc. So overall, do you think the rationale behind that could potentially be the fact that these are the companies that would have hired more aggressively in overseas markets, and there seems to be some sort of a saturation when it comes to the blue chip stocks which are already operating in a market like the US?
So yeah, you really have to deep dive into what is the number of people that each of them are employing in the US versus how many work out of India. A lot of the bigger companies have reduced their count outside, long back when there were H-1B visa issues in terms of number of visas that they were actually limiting based on certain restrictions. So I think some of that containment was already done. Having said that, tech as a sector, has been growing far slower than many other growth parts of the market. So, when it comes to asset allocation, you seriously have to think whether you want a significant allocation to tech or not. I think the only time we saw a significant rally was 2021, during COVID, when a lot of work had to be outsourced or done from home, and the tech sector got a boost. But when you really look at the long-term trend of tech, you see the pace of earnings and the margins declining over a period of time, over a 5 or 10 year period of time. And that is where, from a long-term perspective, I don't really see it as a significant place where I want to, park money,
All right.
because I would end up underperforming relative to growth.
All right, Rohit Srivastava, let's leave it at that for today. But thank you so much for your time and for joining us here on the Morning Brief at 9. Pleasure having you.